Here's a simple question for investors. With gold trading at nearly $4,000 an ounce, would you accept the merits of an economic study on a gold mine conducted at a gold price of $8,000 an ounce? What about $10,000 an ounce? What about the merits of an economic study on a silver mine conducted at, say, $100 an ounce? Well, we trade at nearly $50 an ounce. Sounds ridiculous, doesn't it? So then my next question for you is, why do we continue to accept the merits of lithium-focused economic studies at what has become a standard study price of $24,000 per metric ton, while lithium trades at the sub $10,000 a ton level? If you haven't figured it out yet, we're examining another economic study for a lithium project. The latest being a PEA presented by NOA Lithium Brines for their Rio Grande Project in Argentina. Let's dive in. All right, with that general complaint put to the side, let's take a look at what's on the table here. NOA's project is found in the Salta province of Argentina, where they intend to extract lithium brine from the Rio Grande Salar. The mine proposed here is conventional in nature, with NOA proposing to use the evaporation pond process once brine is pumped to the surface. But there seems to be a lot of maybes in play here, despite this being an economic study. First, while the evaporation pond process is what has been selected in terms of extraction method, NOA also intends to examine direct lithium extraction or DLE methods as part of the pre-feasibility study phase, which could impact recoveries and overall production. Secondly, while the study is based on an operation that is to produce 20,000 tons per annum of lithium carbonate, economics have also been provided for a scenario where NOA doubles the operation to produce 40,000 tons per annum of lithium carbonate, with the company appearing a bit uncertain in terms of what size of operation they ultimately want to construct. But they might also produce lithium chloride instead of lithium carbonate, which is an alternative scenario that they also looked at. The production of chloride instead of carbonate is said to reduce CapEx by 30 to 35%, while reducing OpEx by 35 to 40%. But details on the overall economic impact were not provided. So while we've got a set of numbers here for an economic scenario, NOA management doesn't exactly seem sold on the presented scenario, which isn't the best look for investors that like project certainty. At a baseline level, what is being proposed by NOA is a lithium operation that would operate for a 30-year period, with average annual production of 20,000 tons per annum of lithium chloride. Production is to come from lithium brine with average lithium concentration grades of about 520 milligrams per liter, which is said to support the use of proven technology while providing optionality for the evaluation of alternative flow sheets in later study phases. For now, extraction is to take the form of the conventional evaporation pond process, which is a proven recovery method that is being used by multiple producers in the region. And because it's so common, very few details were provided by NOA on the process as a whole. What we do know is that some brine extraction wells and evaporation ponds are going to be used, but we aren't certain how many. We also know that a lithium plant will need to be constructed to process the lithium into lithium carbonate, which is a process that will require purification and concentration, boron solvent extraction, carbonation, and eventual lithium carbonate production. But NOA has also suggested that they intend to evaluate a scenario under the pre-feasibility stage whereby they will produce lithium carbonate on site and then ship the product to a downstream carbonate plant in Güemes, Salta, which would inherently lower construction and operating costs. As for the potential scenario whereby production is doubled to 40,000 tons per year of lithium carbonate, NOA has indicated that the expansion would be viewed as a phase 2 expansion, with the additional 20,000 tons per annum of extraction to see construction begin after initial commercial production is achieved on the first 20,000 tons per annum phase. By framing it as an expansion, the approach will basically see the expansion paid for by the cash flow of phase 1, reducing execution and ramp-up risk. Moving to the costing side of the study, despite the seemingly simple extraction method, costing here is not cheap. Initial capital costs under the 20,000 ton per annum scenario sit at $706 million, with $414 million attributed to direct costs. A large part of that is the well field and pond portion of the operation, with evaporation ponds expected to cost an estimated $197 million, with the wells adding a further $22 million in costing to that side of the operation. The lithium plant, meanwhile, accounts for $195 million of the direct costs, the biggest portion of which is attributed to utilities and services at $50 million. A further $116 million is attributed to indirect costs, $12 million to owner's costs, and $163 million to contingencies, the latter of which is estimated at 30% of direct and indirect costs. Sustaining capital, meanwhile, was not provided for the life of the project. On an operating basis, annual costs are estimated at $118 million, which, when divided by annual estimated production of 20,000 tons of lithium carbonate, comes out to cost per ton of $5,900. That figure, however, does not include royalties or taxes, and an all-in figure was not provided by NOA. As for the 40,000 ton per annum scenario, capex figures were nearly double, with total capex estimated at $1.3 billion, of which $810 million were direct costs plus $207 million in indirects, $24 million in owner's costs, and $305 million in contingencies. Annual costing overall in this scenario is estimated at $222 million, which equates to a slightly lower $5,500 cost per ton operating cost, which again does not include taxes or royalties. So how does this shake out in terms of economics? Well, using that $24,000 per ton LCE figure, NOA figures that the net present value of the project sits at $1.3 billion on an after-tax basis, alongside an IRR of 22.6% and a payback period of 3.4 years, which is based on 20,000 tons per annum of production over a 30-year period. Alternatively, the 40,000 ton per annum operation is estimated to contain an after-tax NPV of $2.3 billion and an IRR of 23.3%, with an after-tax payback period of 5%. We should note, however, that this is also for a 30-year period, and seemingly discounts the fact that construction on Phase 2 wouldn't commence until Phase 1 achieved commercial production. So it's a bit unclear how accurate things actually are here for this scenario. All right, so let's wrap it up. As for next steps, NOA has indicated that they intend to now move things towards a pre-feasibility study, with exploration ongoing to support such a study. With that exploration to include drilling pumping wells and freshwater wells while analyzing hydrogeological modeling and basin-wide water balances. Process pilot studies are also expected to occur under this phase of development. From our perspective, as things stand, the Rio Grande project as a whole is rather murky. NOA simply presented to investors too many options for the path forward, and as a result, a clear picture on what they actually want to do wasn't presented. Now they have the task of making some hard decisions. All right, everybody, thanks for watching. I know we don't cover lithium a ton on this channel, but if you want more lithium coverage, let us know. Also, if there's stories that you want us to cover, pretty much any sector, you name it, as long as it's Canadian small cap, we're there. Just let us know in the comment section. All right, everybody, thank you for watching.